The Reserve Bank is releasing the Financial Stability Review, looking at the stability of the financial sector. The report will analyse the financial sector under the current environment of uncertainty in light of the spillovers of the Ukraine-Russia conflict and high inflation. Let's take you live to that.
The bank sovereign nexus, as identified in the 2021 first edition of the Financial Sector Review, liquidity in the South African government bond market will be monitored more closely from a financial stability perspective. In addition, this edition also focuses on the role of the SARB as a resolution authority for all designated financial institutions and the establishment of the Corporation for Corporate Deposits as a subsidiary of the SARB. We have identified the SARB about the Corporation for Deposit Insurance to actually say to you, to South Africans, that the South African financial system is now not just more resilient, but we now would be having an explicit deposit insurance, which means that depositors are protected. We have always had depositors protected, but that protection had actually been implicit. What the establishment of the Corporation for Deposit Insurance would do is that it would become more explicit and actually operate more like an insurance scheme. On the panel today, we have got our Deputy Governors, Deputy Governor Kuben Naidu, who is now responsible for financial stability, Deputy Governor Fundi Chasivana, who is also the CEO of the Prudential Authority, Deputy Governor Rashad Kasim, who is responsible for financial matters. I would also be inviting Nicola Brink, who is the head of the Financial Stability Department, to walk us through the presentation. And we also have Jack Waters, who is heading the Resolution Planning Division in the Financial Stability Department. Nicola, over to you to do the presentation.
Thank you very much, Governor, and good afternoon to everyone. I'll be doing the presentation. Zayanda will share it and help me navigate through the slides. It's a pleasure to present this edition of the Financial Stability Forum report at this forum. I trust that you'll find it interesting. I think before I start, I would like to acknowledge all the staff that contributed to it in various ways, both in content, editing and design. I would also like to introduce our brand new editor, Herke Stein, who really hit the ground running with his latest edition. I just want to check with Ziyanda whether she's going to put the presentation up for us. It's coming. Great, thank you. So we can move to the next slide. The first 5 parts of my presentation will summarize the various aspects of our financial stability assessment for South Africa. The last section will focus on the thematic topic that we discuss in Chapter 2 of the publication, namely the introduction of a new resolution and deposit insurance framework. This framework closes important gaps in South Africa's financial safety net, and that's why it was also the inspiration for the pretty cover of our FSR this time round. Next. So the key messages in the FSR is taken directly out of Chapter 1. In essence, and overall, our assessment of the financial system is that it remained resilient despite challenging conditions and underlying vulnerabilities. In aggregate, financial institutions met their prudential requirements and there were no material interruptions of financial services and activity. While we point out some sectoral vulnerabilities in the publication, these are not systemic at this stage and are being monitored. Zianda, you can move on to the next slide.
She seems to be going backwards instead of forward.
Apologies for that, Nicola. Technical glitch.
No problem. We are now at the one that starts with actions by the SARB. I'll continue in the meantime. This is a text slide. So as the Governor indicated, the Financial Sector Regulation Act requires the SARB to take appropriate actions to protect stability if we detect any build-up of excesses or instability. The SARB continued to do work with the Prudential Authority on this bank sovereign nexus that we highlighted last year. Then, because financial stability is a shared responsibility, we collaborate closely with other regulators and authorities who are members of the Financial Sector Oversight Committee, or FSOC. We published several discussion papers on the new resolution and deposit insurance framework, and work is continuing to implement those frameworks. Then the Financial Stability Committee kept the counter-cyclical capital buffer at 0%. The CCYB is a macro-prudential tool. It's designed to curb excessive credit growth, or bank credit growth to be specific. But in the absence of excessive growth in bank credit, there was really no need to increase the buffer. Next. Governor, I think there's a problem. Zianda, this is not the right presentation. I think you were on another presentation that we had earlier. So apologies for that. So that's the right one, and we are starting with global developments. Just 2 slides down. Yes, stop. There, next one. So the global economy was still recovering from the effects of the pandemic when Russia invaded Ukraine. That invasion and the war that followed triggered renewed volatility, disruption of supply chains, and also sanctions. This was combined with further flare-ups of COVID in various parts of the world, and China, among others. Well, China had severe lockdown rules. Already high inflation in several advanced economies increased further to 40-year highs, and the major central banks reacted by increasing interest rates and in some cases announcing intentions of quantitative tightening. Volatility was particularly high in emerging market currency and equity markets. We expect material spillovers for emerging markets, among others, through the capital flow channel and exchange rate channel. Next. These composite indices of financial conditions in the EU, US, and Japan give an indication of the ease and cost with which funding can be obtained. If the index goes above the 100 level, funding becomes more expensive and harder to access. The graph shows that funding conditions in these countries are still relatively loose, at most neutral in the EU, but there have been significant tightening in the EU and US, among others, since the beginning of 2022. Next. Increases in interest rates have a much more severe impact in an environment of high debt levels. The blue bars in this graph show how debt levels globally have steadily increased over recent years, but especially since the outbreak of the pandemic, as governments stepped in to support their economies. Global debt reached a record high of $303 trillion at the end of last year. The global debt to GDP ratio has declined from its peak of over 360% in 2020 as global GDP recovered, but the amount of global debt is still about 3.5 times the size of global GDP. Next. This graph shows a number of volatility indices that Bloomberg publishes for various asset classes. Volatility for all the riskier asset classes have increased significantly since the previous FSR, especially so for emerging market equities, emerging market currencies, US treasuries and derivative markets. The only market that remained fairly stable was gold, which of course is a safe haven asset. Next. We now move to the SABC's view on South Africa's financial stability conjuncture for the 6 months up to the end of May, as well as the future outlook for financial stability. Next. We note that financial institutions operated in a challenging, low-growth environment. The pandemic had a disproportionate impact on low-income earners, thus increasing an already high degree of inequality. Adding the rising cost of living to this situation,
saying that the South African banking system does remain resilient.